First of all, non-banks, if you look at international markets, focusing on emerging markets, non-banks seem to be becoming more important vis-a-vis banks in terms of issuances and in terms of borrowing. Second, there has been a switch in which, if you look at offshore issuances, in the past they were dominated by nationals of advanced economies, while now they seem to be dominated by nationals of emerging markets. And third, there has been a reversal of sort of the phenomenon of redemption from original sin. So in the late 90s, we had written all these papers about original sin, that is, countries find it hard to borrow, emerging market countries find it hard to borrow in their own currency. And then in the first half of the 2000s, people say, there has been redemption because now there is a lot of borrowing in domestic currency, in domestic market. But then if you look at the last few years, there's been a reversal with, again, a lot of foreign borrowing abroad. And so let me maybe just emphasize this last point. So we have good data. So working with people at the IDB, you tend to have good data for Latin America, but it's a more general phenomenon. So let me focus 1 second on Brazil. So the top bar is an average of the structure of bond issuances of Brazilian nationals. The yellow bar are issuances in domestic currency. The blue bar are issuances of Brazilian nationals and Brazilian residents and nationals abroad. So this is like Petrobras issuing in New York. So that's the blue bar. And then this brown red bar to the left were issuances of Brazilian nationals but non-resident abroad. So this would be Petrobras Cayman Island issuing in New York. And now if you look at what's happening after 2008, you've seen that the yellow bar has become much smaller. So again, less issuances in domestic currency. And the blue bar has become, the sum of the blue and brown bars have become bigger, so more issuances in foreign currency. And moreover, there's been an increase in issuances from offshore centers. So it's not, if Petrobras wants to borrow in New York, it doesn't borrow issuing a bond as Petrobras Brazil, but issuing a bond as Petrobras Cayman Island. And then, so there is a general trend in this direction. And this just, again, here the yellow bar is, again, local currency issuances, and the brown bar is dollar issuances, and what you see there is issuances in other currency. But again, if you look at this, you can see, again, there has been a huge increase of foreign currency issuances over the last few years. So that's just, I want to give you a little bit of a picture of what's going on. So one person that has been thinking about these issues a lot is Yun Shin at the BIS, and he has a nice paper with Lara Chow, which used to be at IDB. I don't know if she's still there, but when they wrote this paper, she used to be at IDB. And basically, we like this paper because it starts saying, if you think at the typical balance sheet of a bank, and if you think about the typical balance sheet of a non-financial corporation, well, what does a bank do? Banks borrow to lend. So, bank gets deposit, which is borrowing, and then it lends. So you should observe a positive correlation between liabilities of a bank and financial assets of a bank, because that's basically the business of a bank. Well, if you think about a non-financial corporation, a non-financial corporation should borrow to invest. And if internal funds are cheaper than external funds, you should actually observe that first you draw on internal funds and then you borrow. So you should observe either no correlation between borrowing and financial assets, or even maybe a negative correlation between borrowing and financial assets. So what does it mean to say that a non-financial corporation acts like a bank, it means that this non-financial corporation has a positive correlation between that and financial assets. So that's their test. Again, this is the Shin and Zhao test more than the Caballero, Panizza, and Powell test. But we like this story. So what we do, we try to see what non-financial corporations in a sample of emerging markets do when they issue bonds domestically and abroad. So, and we ask, do they act like non-financial corporations are supposed to do, that they issue these bonds and then they use the proceedings to finance some sort of real investment, or do they act like banks and they issue these bonds and then they keep the proceeding? I will call it cash, but it's not really cash. They keep the proceedings in liquid financial assets. That's what I call cash, but it's not really cash. Okay. So to do this, it requires some work, because we wanted to get balance sheet data of firms, and we wanted to get bond issuances by firms, and this come from different data sets which don't have a unique identifier. So two data sets. So basically, you have to hand match bond issuances which are from Dialogic and firm level data which we take from WorldScope. So, and we have 18 emerging market countries. We take up to the 50 largest listed non-financial corporation in these countries. Our sample does not include India, doesn't include China either. So, and I was discussing with Ajay before. The decision of the sample was made at some point when we started collecting the data. To be fully honest, I don't remember how we decided the sample. So these are the countries in our sample. So that just to give you an idea of what these firms, the firms in our sample, were doing during this period. So we use data between 2000 and 2014. And the red bar are issuances of bonds in the domestic market, in local currency. Actually, we look at the currency, but they're mostly domestic market. And the gray bar are issuances in foreign currency, and to be precise, are issuances in what we call hard foreign currency. So here there are issuances in dollar, yen, pound, euros, and Swiss francs. But at the end, they're all dollars. 99% of it, this is dollars. So, and again, you can see more or less the same thing I showed you before. There's been a huge increase in issuances in foreign currency. So the first thing we do, we run a test which is similar to a test of another paper by Yun Shin. This time is a paper with Valentina Bruno, and so what our model on the left hand side, we have a measure of financial asset. And on the right-hand side, we have this measure of bond issuances, and we have three measures of bond issuances. One is the log of 1 plus the amount of issuances. The other one is 1 plus is the log of 1 plus the ratio between issuances and sales. And the third one is just a dummy that takes a value of 1 if I issued and 0 if I didn't issue. And then I control for a bunch of firm-specific factors. I have a firm fixed effect, and I have a country year fixed effect. And then I look basically at whether there is a correlation between cash holdings and issuances. So this is the test of whether bank acts like financial intermediaries. So that would be the beta in that model. But then I also interact the issuances with a measure of the spread between the local interest rate, so we take the local deposit rate, and the cost of funding in New York. And this is a sort of a first test if these guys, if they do act like financial intermediaries, they do they do this to engage into carry trade activities, and getting a positive sign in this delta would be consistent with the idea that these firms engage in some sort of carry trade activity. So what do we get when we run this and by the way, this regression, in fact, we were writing on this paper and we'd run this regression, but by the time we had the result, the paper by Yun and Valentina was out, and they do exactly the same thing. So this is So we did it more or less at the same time, but they came out with the paper first. So this is more or less corroborating their result rather than a new result. And it's interesting because they use a completely different sample. They use a slightly different methodology, but we get exactly the same result, which is, I guess, good. So what do we get? We do get that foreign currency bond issuances are positively correlated with cash holdings. So that's the coefficient beta there, is what this 0.014 that you get there, this 0.79 and this 0.11 there. And we also get that this effect seems to be stronger when opportunity for carry trade are there as measured by the spread, but the effect is never statistically significant. So you see this FXB interacted with the spread is always positive, but is never significant, and in fact is never even close to being statistically significant, okay? We also split our country years into country years in where this measure of the spread is above the median, and in country years in which this measure of spread is below the median. So HP, which should be HS, it's high spread country years, and LS is low spread country year. Now, if you look at this, you'll find that foreign bond issuances are correlated with cash holding in high spread country years, and are not significantly correlated with cash holding in low spread country years. So that seems to go in the direction of carry trade. However, while in one case is significant, in the other case is not significant, these two coefficients are not significantly different from each other. So again, depends how you want to interpret it. So, but again, so this is just what Valentina and Yoon do, and we just, in a sense, replicate what they're doing. So the contribution of this paper is to try to go more into the question, why do these firms issue abroad? And we have sort of three possible stories. One is the carry trade story, which I will expand on it in a minute. But other two possible alternatives are these firms are acting like banks because they're basically completing domestic markets. So you have poorly working domestic financial markets, and if you think that large firms have more information about their suppliers or also about their clients, then in a sense these firms can borrow for their suppliers or their clients and then lend to these guys. So you would expect, if that's the case, you would expect this phenomenon to be more prevalent in countries with poorly working financial markets. So we test this hypothesis. And the third hypothesis that we look at it, there was a retreat of global banks after the global financial crisis. So we're looking whether this phenomenon is more important in country years where there was this retreat of lending by global banks. And just to give you a preview of the results, we don't find any evidence for the last two stories. So we don't find any evidence for this corporation completing markets or for this corporation substituting global banks, but we do find evidence for the carry trade story. And the way we look at this, we ask ourselves, well, where do non-financial corporations have an incentive to engage in carry trade? Well, we think that they have an incentive to engage in carry trade in countries where there are capital controls. Why? Because non-financial corporations, in a sense, are better equipped to evade capital controls because, intercompany loans are classified as FDI, so they're not as strictly monitored as traditional capital flows that go into the capital account, and also they can do all sorts of other things. They can do over-invoicing, under-invoicing. So in a sense, our view is that non-financial corporations have a comparative advantage vis-a-vis banks in going around capital controls, and therefore, if these corporations are engaging in carry trade, we should observe this phenomenon to be more present, to be stronger in countries with high levels of capital control. So that's our test. So this is just some suggestive evidence. So this is a correlation between bond issuances abroad of banks and lending by banks domestically. And this line, which is sort of positively sloped, are countries with low capital controls, and the country which is negatively sloped are countries with high capital controls. So again, it seems the case that if there are little capital controls, banks go abroad, they borrow, and they on-lend domestically, but where there are high capital control, this does not happen. But the opposite is true for non-financial corporations. Here, the positively sloped, that sort of flat curve, is the behavior of non-financial corporations in countries with low capital controls. So they borrow abroad, that's the horizontal axis, and they put some of the money in domestic deposits, but not so much. But where there are high capital controls, this relationship is much steeper. So we use firm level data to test this. So that's our basic specification. So more interaction. So again, on the left-hand side, we have cash holdings of the firm, and now we have the usual set of controls, and firm fixed effect, country year fixed effect, and we have this measure of the spread, a measure of capital controls, which actually this is not capital control, it's capital account openness. So K goes from 0 to 1. 0 means fully closed capital account, 1 means fully open capital account. And then this interaction between carry trade opportunities, which is this measure of the spread, and our capital account openness measure. And if our story is right, we should expect to find delta to be positive. That is, these guys engage in carry trade when the capital account is closed. And we expect to find phi to be negative. That is, when the capital account is open, the full effect would be delta plus phi. So we expect phi to compensate delta, and in a sense, and having delta plus phi to be close to 0. So that is what we test, and since I'm telling you about this, you can guess that that's what we find. So this is the bond issuances. This is the bond issuance interacted with the spread. And again, so you should imagine this, so the incentive to do carry trade when the capital account is fully closed. And this plus this is the incentive to do carry trade when the capital account is fully closed, is fully open. So we get everywhere that these firms seem to engage into carry trade when the capital account is fully closed. So this coefficient, and this coefficient there. And this coefficient is always negative and statistically significant. And if you add up these two coefficients, you always get something which is not significantly different from 0. That's our punchline result. And then we do some. And then we ask ourselves, what type of capital control should really bite? Well, the capital control that should really bite are controls on inflows. So this was done with the Chin and Dito data set of capital control. Then we used the Fernandez and others measure of capital controls, which allows to split between controls on inflows and control on outflows. And we see that if we use if you use inflows or outflows, we get the same result, but because these two variables are highly correlated. But in a sense, if we measure inflows and outflows together, we get that what matters is control on inflows. We also try to get the overall index of capital control and the component of control on inflows, which is orthogonal to overall capital control. So this would be this one. And again, you get that what matters is control on inflows. And if you do the same exercise for control on outflows, you actually get that for outflows, it goes in the opposite direction. So these are graphs of the marginal effect. This is overall control, Chin and Dito and Fernandez and others. This is control on inflows, and this is control on outflows that goes on the opposite direction, but is never statistically significant. We test the other hypothesis. We don't get anything. We see, and then we ask, is something that is really to do with issuances of foreign currency bond, or is just, issuances of bonds? So if we run the test with local currency bonds, we don't get anything, again, supporting the story of carry trade. And then, we run some instrumental variable regressions. And again, we test these three hypotheses. We find evidence supporting the idea that these guys are trying to go around capital controls, which again is interesting for some of the discussion we had yesterday and maybe what Rex will talk about today about the effectiveness of capital control, because what we seem to find is some evidence for regulatory arbitrage.
Let me quickly get started. So I think that this is an interesting and important phenomenon for all of us to take interest in. Here's a way in which I like to think about it. We have a large literature on the difficulties of capital controls, on how capital controls don't actually deliver as a useful tool of macro policy. So to take an example about the Indian story, in the 2004 period, we had a very inflexible exchange rate. And at the time of the business cycle expansion, monetary policy autonomy was lost. We got very low real rates. And that begs the question that even though there was so much capital controls, how was monetary policy autonomy lost? Okay, you see the same story at the time of the Lehman crisis. You would have thought India is one of the most closed capital accounts of the world. But literally the day that Lehman went under, the operating procedure in India broke down. And so there was something very different going on compared to what you would have thought based on looking at the capital controls. And similarly, look back at 2013, there was a very big currency defense and almost everything failed to work as was expected. So there's something going on about why capital controls are not working as people might have hoped. So the interesting next question is, how are economic agents doing it? How are economic agents getting past the capital controls? And in my mind, there are two main stories. One is the role of trade misinvoicing, and the other is the role of non-financial firms doing increasingly financial activities, because the footprint of capital controls is much greater on financial firms than on non-financial firms. So that's the setting of this paper. And I think this is a very fertile line of thought that is worth exploring. Let me tell some stories and show some anecdotes about what we have seen. Think of the arbitrage between the rupee forwards in India and the rupee forwards trading outside India. Rupee forwards trade outside India in Singapore, in London, places all over the world, in Berlin, in Moscow, and so on. This is a graph of the percentage error between the onshore rupee forward and the offshore rupee forward. So you see it's mostly like 0.1% off. Okay, that's a very small pricing error. Now you'll be shocked to know that the regulations say that banks are not allowed to do this arbitrage. Okay, so can you imagine? Banks were supposed to be the bread and butter of currency forwards arbitrage, of currency arbitrage, are told by the Reserve Bank of India that you cannot do this arbitrage. I believe in roughly 2013, the regulation was made far more stringent, and informal phone calls were made to international banks that we really don't like it if you do this arbitrage. So that begs the question, who's doing this arbitrage? Okay, so clearly the thing is pricing properly, even though we have a regulation that is being pretty stringently enforced. The onshore forward and the offshore forward is getting arbitraged. And to the best of my knowledge, the answer is this arbitrage is being done by non-financial firms, because non-financial firms are not regulated by the RBI and they have far more flexibility in what they do. Here is another story that I like to tell. Think of the business of running one floor of a skyscraper with dealers who trade fixed income currency. Right? I mean, this is something that happens everywhere in the world. Just think of the life of that trading room, people looking for arbitrages, people looking for trading opportunities, and doing the business of what dealers do. Okay, where would you find this in India? Would you find this in a bank? No. Jayesh will be the first to agree that what happens in a treasury in India is really not what happens in a treasury anywhere else in the world. Would you find this in a hedge fund? No, because you can't really start hedge funds in India. So where do you find this entrepreneurial spirit of trading by a bunch of dealers? You find it in the treasuries of non-financial firms. Okay, the most impressive treasuries in India today are springing up in non-financial firms. Why is that? Because they're allowed to. Okay, because the regulations don't crush their ability to do financial business. So it's really ironic that some of the most sophisticated treasuries in India, you get the culture of a treasury, you get that hunger of a trading floor in the treasury of a non-financial firm. You don't get it in financial firms in India. Okay, here's another story. Indian multinationals are able to run global treasuries. I was on the board of a large listed company, and I was astonished to find that in the basement of their headquarters, they were running a global treasury. So there is a treasury, which is like 18th floor. And then late in the game, they started a global treasury, which is sitting in the basement. So you would normally think, that global treasury would be a really important operation. It's a little skunk works that's hidden away. But hey, they have $1 billion in a subsidiary in Amsterdam. They have a few $1 billion in London, and they're running a global treasury. Now, by the rules in India, external commercial borrowing for non-financial firms cannot be done for a maturity of less than 3 years. So there's really no money market financing as per the capital controls. But Indian multinationals are able to borrow outside India through their subsidiaries, and these global treasuries are very much doing money market operations. And to the best of our knowledge, that's what happened when Lehman died, that the refinancing in the money market in London broke when Lehman broke. So the Indian multinationals ran out of money in London through which they could pay up on their commercial paper that was issued a few weeks ago. And they started taking money out of India, and the Indian money market choked. And that's a story that we've told in another paper. So this is an example of how the non-financial multinational firms are the ones doing the cross-border activities that are prohibited for financial firms. And I want to emphasize some of the themes that the paper talked about, which is there is a whole ecosystem surrounding the big companies. So here is a personal story. I don't want to name the firm, but I know them very well. I know every bit of what is happening here in great detail. This is a large automobile company. Step one, the boundary of the firm in India is drawn a little wrong and a little wonky because of labor law. So every large firm has a great incentive to not really be the firm that it would like to be. So the true employment of the firm is 3 times larger than the apparent employment of the firm. So there are entirely captive operations, but the boundary of the firm is drawn differently. So there are firms sitting outside who are actually a part of the same production process. It is just a legal structure that there is a legal person who is constructed who has 1 unit of employment, and then there is 2x of that, which is a set of legal persons constructed outside to beat labor law, to become more flexible vis-a-vis labor law. So that's the distinction number 1. And then the distinction number 2 is the ecosystem, that as with firms all over the world, surrounding every large firm, there is an entire ecosystem of component manufacturers, dealers, people who do repairs, and so on. Now, for the second group, there is a comparative advantage that the non-financial firm is better equipped to judge the equity and debt investments into the ecosystem, because they see those firms, it's running on one big ERP system. They can see the receivables and the orders that have been placed with each of these firms. So they have amazing information, and they're able to make financing decisions more readily. For the first case, which is the satellites, they're actually the firm. So this entire complex is running out of the treasury of the mothership. The mothership is the entity that is shown to the financial system. That's where equity and debt capital is raised, and that money is feeding into this entire network. So in my opinion, most large non-financial firms in India are financial intermediaries to a significant extent. Now, this is partly because of the funny labor law phenomenon. It's partly because of superior information about the ecosystem, and it's about the infirmities of finance, that because we have not allowed a proper financial system to come about, these things are moving to the non-financial firms. So I have a conjecture that somewhere inside this, trade misinvoicing is also playing an important role. So there is a financial side, and then very often you will end up with cash in the wrong place. How will you move it around? Trade misinvoicing is going to be an important part of this puzzle, but this is pure conjecture. I don't even have anecdotal evidence of this nature. So turning to the paper, why single out overseas bond issuance? Because it seems to me that for these kinds of situations, for these kind of firms, access to the domestic bond market is also a part of that same financing activity that they're doing for their ecosystem. So I find that there is a remarkable fact in this paper, which the authors also agree is quite remarkable, which is that when the firm does a foreign currency bond, it tends to hold more cash, but this is not the case with domestic bond issuance. So I have an opinion and a hypothesis for what might be going on. It may be that there are opportunities, there are windows of time when you can access the overseas bond market, whereas maybe for the large firms, the domestic market is more accessible. So you may be far more opportunistic that when a financing window opens up in London, you grab that opportunity and for some time you end up holding cash. Whereas the domestic market may be more consistently accessible. So there may be a home bias type story there. I would be curious if we could make this paper more causal. It's a bunch of regressions right now, and there are many concerns about how this is done. And what we should be doing is looking for the big changes. We should be looking for contrast in the design. So for example, you could use Gurnain's database about capital flow measures and look for natural experiments where a country greatly increased or decreased its capital controls, and then you can do some matching and you can get a treatment and control, and that would be a lot of fun. Similarly, exploit changes in tax policy, exploit large capital account liberalizations. I think that would really give teeth to the paper. The authors are very controlled and say that this raises a whole bunch of regulatory questions, and I just wanted to think about what this would do to us. So suppose there is a large non-financial firm that is doing financial business. Is there a consumer protection issue? No. Is there a microprudential regulation issue? No. Is there a systemic risk issue? It would need to be extreme in its scale, because I think each non-financial firm is doing a couple of $1 billion of this, and if the firm goes belly up, frankly, nobody cares. It doesn't add up to systemic risk. Is there a resolution question? No. So I really don't see a whole lot of financial regulation coming out of this phenomenon. What is true is that this is less efficient than having a financial system. Okay, so for example, think of the way a financial firm would invest in the sophistication of systems, risk management, arbitrage, algorithmic trading. For a non-financial firm that is really moonlighting in finance, they would not do this at that level of professionalism. And also they cannot overtly sell financial services because they're a non-financial firm. They don't have a license to sell financial services. So I see an opportunity cost that this is not as efficient for a country as having a financial system. But when a country has a regulatory machinery that is that makes it difficult to do financial business, this may be a good answer. So I'm going to stop here. Thank you.